Hi, good morning. Welcome to the live webinar. My name is Bickey Rai. I'm a relationship officer in SmartFX. All right, so today I'm going to talk about very important topic, and that is risk management. So without any further ado, let's get started. Introduction. Definition of Forex trading. Forex trading or Forex exchange trading refers to the act of buying and selling currencies in the Forex exchange market with the aim of making profit. It's one of the largest and most liquid markets in the world, operating 24 hours a day, 5 days a week. So Forex trading, actually you can buy and sell of any currencies of any countries in order to make profit. And it's one of the largest and most liquid markets in the world. That means around $7 trillion of transaction takes place every single day, which is buying and selling takes place. And it's open for 24 hours a day and 5 days a week. And it's good for the people who are working 9 to 6. They will have a time after their office. Okay. Okay. So importance of risk management. Risk management is in Forex is essential to individuals, group of individuals, and organizations since it enables them to implement measures that help mitigate Forex risks and its negative impact. So risk management is really crucial for not only for retail traders, it's for any institutional traders like hedge funds, banks, because it actually mitigates your risk and also remove the negative impact involved with it. All right. Okay. So why management is crucial in the Forex market? So there are many factors. Let's talk about with the capital preservation. The primary goal of the risk management is to protect your trading capital. By employing strategies like stop loss orders, you can limit potential losses and ensure your capital remains intact, even during the unfavorable market conditions. Capital preservation, it's very important to protect your capital. Think like you're climbing a mountain, and while reaching a summit you run out of oxygen. Okay, so what will happen? You will die, right? The same thing is capital. You should consider capital as your oxygen, so you always protect your capital. All right, by not trading randomly, uh, always putting a stop loss, always understanding how much you're gonna risk, okay, position size, everything. So you have to protect your capital. Consistency. Effective risk management helps maintain a consistency in your trading. By managing risk, you can avoid significant losses that could disrupt your trading strategy and emotion stability. So effective risk management actually can help your trading consistency, because consistency is really important in trading. Okay, the more consistent you are, the more successful you can become in trading. So risk management actually can help you to lose a significant amount, and which can with that, and it can actually help you uh, you know um, blowing your account, and also it will help you to manage your emotions. Okay, so long-term success. Successful trading requires a long-term perspective. Risk management strategies such as position sizing, setting a risk to reward ratio help traders achieve sustainable success by balancing potential gains and losses. So if you want to have a long-term success, or risk management is really important. And one thing is true, that the longer you stick to this game, the more successful you will become. Okay, so how do you stay in this game for a longer period of time? Simple, just following the risk management, understanding your position size, understand your risk to reward ratio, can actually keep you in this game for sustainable period of time. Don't worry, we're going to talk about risk to reward ratio, position size later. And emotional control. Managing risks can help traders maintaining emotional resilience. By having a clear risk management plan, traders can avoid impulsive decisions driven by fear or greed. So emotional control is really, really important. So managing risk actually can, help your emotional state. Okay, if you have risk management in place, then you will not make an impulsive decision. You will not enter the market randomly. Okay, you will not trade or open a trade driven by fear or greed. So emotion, it really, really helpful if you understand this risk management. We're going to talk about this more in detail uh, in next. Okay, so risk management strategies. Okay, there are 5 factors I would like to discuss which are significant. So let's start with the setting stop loss and take profit levels. Setting stop loss and take profit levels, these two are the crucial elements of trading. Stop loss, which will actually prevent your capital, prevent you losing drastically or blowing your account. And take profit is making you understand that how much you can make the profit. For example, stop loss. When you put a stop loss, you are willing to risk, let's say 1%. So you will be only losing a 1% in that trade if the trade goes against you. But if you do not put the stop loss, you might lose 50% or even 100% and can blow out your account. For example, if you lose, let's say $10, I'm just giving a new example, $10, your stop loss is like you can willing to lose $10. So if the market goes against you, you will be only losing $10, not more than that. But if you do not put stop loss there, you might lose $100, $200, $500, or blow out your accounts entirely. And take profit. You should understand where you have to book the profit. For example, you are opening a buy position of gold from support level, and you have placed take profit in a resistance. Okay, so when the price goes to your direction and goes to the resistance area, then you will have a take profit. I mean, the system will automatically close your account, and the profit uh, will be put in your equity. But let's take another scenario. If you do not take profit, and you simply just let the market go up, so it went up to the direction, and you are in a profit, and suddenly it reached to the level where there is a resistance or supply zone. So market reverses and takes away all your profit, even hits your SL. So it's really, really important to put this TP, take profit, right? Okay, so let's talk about diversification. So diversification, that means do not put all the eggs in one basket. If you put all the eggs in one basket, if the basket gets stolen, then you will left nothing. The same scenario, if you open all the positions in gold, let's say 5 to 10 or 5 positions or 4 positions, 10 positions, then if the market goes against you, then you will be losing a huge amount of money. However, if you have diversified and opened, you have other asset as well, let's say, or currencies. Okay, you have opened 3 4 currencies, like major currencies like euro USD, GBP USD, or USD JPY. So for example, if the gold went against you, the position went against you in gold, okay, you might incur losses, but the positions in currencies might go in your direction, and you will have a profit. So that means you are hedging. That means you are actually you know, not incurring losses, big losses, but you're also having a profit in uh, simultaneously. So this is a reason that diversification is really, really important. Okay, so the third one is using leverage wisely. This is very, very important. Leverage is something, it's a double-edged sword. If you use it wisely, it can make you, but if you don't use it wisely, it can break you. So do not use a high leverage. All right. For me, I use a leverage of 1:100, and that is also pretty high. But yes, I have to have this much leverage because because it make can if you're right, can give you if it can make you a good profit. But as I told you, I'm a big fan of risk management. I always make sure that my stop loss is there. Okay. Position sizing is another important factor. See, we have different uh, capital. If your capital is small, if your equity is less, do not go for a bigger position size like lot, because see, it's not a gambling, it's a profession, right? It's a business. So if you have a small capital and if you want to double, triple your money in just days or in hours, then you end up losing all of your money. I know there might be beginner's luck. So because of beginner's luck, you might win, but in the end of the day, the money will go. So position sizing is really crucial. Choose a position size according to your capital. If you have a bigger capital, you can choose a bigger lot size. If you have small capital, choose a small lot size. Now, risk to reward ratio, my favorite topic. In fact, every successful 1% uh, who comes like under 1% of successful trader, they use this risk to reward ratio. So let me explain you what risk to reward ratio is. So there are many risk to reward ratio, 1:2, 1:3, 1:4, and more. So always the minimum you can choose 1:2. Okay. So that means if you're willing to lose $1 in order to make $2, that is 1:2. So let me give you a very fine example. So in one day, you open 6 positions in gold, right? And 3 is successful and 3 is loss. 3 wins, 3 losses. So when you lose, you're losing $1 in each position. That means $3 you're losing. But when you are winning, you're winning $2 per trade. That means 3 to 3 is a $6 is your total profit. So when you subtract $6 from $3, still you're making $3 as a profit. So this is called risk to reward ratio. So 1:3 is much more better. 1:4 is much more better because see, this is trading is a probability game. Okay, it's not a guaranteed game. Every successful trader, every elite traders, they lose. All right, but the they know this thing which is called risk to reward ratio. For example, you lose one trade in the next trade you can actually win. So when you lose $1, but when you are you're making $2. So as I told you, this is the example which I told you. It's really, really significant. I mean, always um, implement this risk to reward ratio in your trading, and trust me, in the end of the day, you will be very, very profitable trader. All right, even though your win rates are 50-50 or below, like 40, doesn't matter. With 30%, still you will be a profitable in the end of the day or end of the month. All right. Now let's talk about the one of the significant, crucial aspect of trading, which is psychological aspect. The first one is managing emotions. The second one is discipline and patience. So let me talk about managing emotions. So in trading, we have different emotions. We human being are emotion being. Okay, we have greed, we have fear, we have FOMO, like fear of missing out. So that's natural. Everyone has this. But if you do not control these emotions in terms of trading, you're not gonna end up, you know, good. For example, you are very good in technical analysis, fundamental analysis, and very bad in managing your emotions. That means you will not be a successful trader. Uh, Mark my word. Okay, and I'll tell you why you can't be a very successful trader, even though you have excellent skills in technical and fundamental analysis. So let me give you a very good example. Let's say you you read a chart, okay, you did all the analysis, technical analysis, and you found out that the gold can be a bullish, gold can go up, okay, and also you checked everything um, fundamental, like inflation is, let's say, inflation is down. So, so central bank might cut the interest rate. So, both the aspects, technical and fundamental, you are very confident that the gold will be bullish, it will go up. So what it did is you opened a long position. Okay. Let's assume the price of the gold is, as of now, is 2,800. And you assume that price of the gold can go up to 2,850. It can go up to $50 movement. All right. Because in the past it has gone, and your technical analysis and fundamental analysis is supporting you that fact. So now you open a long position, and let's say you open a 0.01 lot. I'm just giving you smallest lot size example. 0.01 lot equals movement of $1 if the market goes up or down. Okay, so 0.01 lot open position, long position. From 2,800, the price started going up. 2,802, then it reached up to 2,810. That means you already had a profit of $10. Okay, now the market started making some correction, because as you know, the market will never go like this in not straight. It always make a correction and goes, make a correction and goes, retest, goes. That's the nature of the market. So when the market is going up, you already made $10 profit. However, market started making some correction there. You could see or some bearish candles. So you started fearing, okay, the market can reverse and take away all my $10 profit. And you start worrying, you started having that fear. Then what do? You close that position, booking a $10 profit. However, to his surprise, after he books his $10 profit, the market goes to his directions and goes all the way to 2,850. So what happened? Was he like his technical analysis was wrong? Was his fundamental analysis wrong? No, he was right. I mean, technical fundamentals, he thought that market can go up to 2,850, and it actually went to that price. But what went wrong? Why he only booked $10? Why he did not wait the market to reach to his TP or his price? In the process, he lost $40, because he could have made $50, but he just booked $10. That means he lost $40. Why? Not because of technical fundamental, because of psychology, trading psychology, because of emotions, that fear. So imagine you would have, you know, um, prevented that fear to come to your mind, and believed in your process, in your system, then you would have made $50. So that's the reason emotion is as significant as technical and fundamental. But for me, it's more than that, more than that. Okay. Now let's come down to discipline and patience. Well, discipline, see, discipline, if you follow the discipline, you will not only be successful in trading, but in general, in life as well. If you're a disciplined person in life, you will be successful than the people who are undisciplined people. Okay, it's a fact. Okay. So discipline really matters in trading as well. Discipline. So what I'm talking about discipline, what exactly discipline is trading? Discipline is sticking to your strategy, sticking to what you have learned, sticking to, for example, risk management. Let's say you always follow the risk management. You always put the stop loss. You always care your capital. You always, know how much you are losing. If you're losing in 1%, okay, I'm going to lose only 1% under any circumstances. Not, fear, not, you know, thinking, oh, I can make a lot of money. No, no, not falling into greed. So that is discipline. Discipline is opening the same position size. If you have a small capital, opening a small position. Discipline is something is very, very crucial. All right. So if you um, respect discipline, you will be very, very successful. So always like discipline. You like, for example, you are a supply and demand trader. So you're always waiting for market to come to your strategy, come to your setup. That's a discipline. Not looking at the impulsive bearish candle or impulsive bullish candle and entering the market. That's undisciplined. So discipline really matters. So if you want to stick to this game and want to become a successful trader, you have to have this discipline in your portfolio. All right. It's really, really crucial. So let's talk about the patience. Well, patience is really, really crucial. So I don't, I'm not sure, like some people understand this patience, but for me, and if you ask to a lot of like successful traders, their common answer will be a patience. Be patient in trading. Because I'll tell you why. See, um, patience is something, you wait the market to come to your setup. For example, see, there are 90% of traders who lose money in this profession, in this business, and there are only 10% of people who are extremely successful. And the reason why? Because they're impatient. They enter the market when they see they randomly, they don't have any strategy and they can't wait. So they, whenever they see, the the bearish candle, impulsive bearish candle, they see, the market is going down, they entered quickly without thinking. Or let's say they buy the, when they see the bullish candle, big candle, impulsive candles, they buy without thinking. Why? They don't have patience, right? So patience is something. For example, you're a supply and demand trader, and you know your age, strategy. So you're not entering in the middle of the market, not looking at those bearish or bullish impulsive candles. So waiting the market to come to your setup, come to your demand zone, and then you enter the position. You open the position like a sniper. We call this sniper entry also. Waiting the market to come to your direction, come to your setup, come to your strategy, then entering in the form of market order or in the form of pending order like buy limit or sell limit. And you know why? Uh, why this is very, very, important? Because if you are entering, if you're not chasing the market and waiting the market come to your strategy, there are multiple benefits. Multiple. The first thing is your risk to reward ratio will be really, really good because you're entering from the discount zone or from the premium zone. Okay. So your discount, for example, you're buying from the demand zone. That means you're not buying from the market price, but you're buying from the your price, your discount price, so that you can buy from the buy limit. That means you're buying cheaper and you're selling in a high price. So that is one of the advantages. Risk to reward ratio will be really good. You can put your SL down and you can put your TP up. Okay, so that's first advantage. And second one advantage is that you will not have emotions. You will not have those greed, fear, or FOMO if you're patient, if you're waiting the market come to your setup and enter the position, because you already know, you have pre-calculated that how much you're losing. You're losing 1%, and how much you're making, 2% or 3%. So already in your mind, you know that if the market goes against you, I'm losing 1%, and that's okay. I can lose 1%. But if the market goes to my direction, I'm making 3% or 4%. So already you have pre-planned, and there you will not feel greed, because you already have TP, target price, where you want to exit. You will not have fear because you already know how much you're losing, and it will not impact you that 1%. And you will not have a FOMO, fear of missing out, if you see candles, impulsive candles, bullish or bearish, because you have opened a position from your setup. So this is the advantage of becoming a patience. All right. So these are the really, really important thing you should, incorporate in your trading journey. Conclusion. Okay, so I've talked about a lot of things, especially, putting the stop loss, following the risk to reward ratio, becoming patience, discipline, and see first. And to be honest with you, this is something you can't do, overnight. It's not gonna happen. For example, if you are, indisciplined trader, and so you say, okay, I heard this guy Vicky and he told me to do this, I'm gonna do it now, I'm gonna do it from today. But unfortunately, you'll repeat the same mistake again, because your subconscious mind has all the information stored here, that trading impulsively, randomly, not following the risk management. So you need to train your mind. It takes time, but it's not impossible. It is possible. Train your mind to be disciplined, train your mind to be uh, you know patience. And this is a biggest skill. Not only you, it is applicable for trading in real life also. If you can if you can, train your mind to be disciplined and patience, it it will help you in your personal life also, not in the professional life. So in personal life also, you can become successful person. So mark my word, if you follow all of this, which I have taught you today, you will be a successful, profitable trader. And last but not the least, importance of continuous learning. Learning. There's a proverb, there's a saying, the more you learn, the more you earn. And that is absolutely correct. Trading is a vast ocean. It's never ending journey. Okay. So traders who is trading for the last 5 years, 6 years, they still learn. So if you guys are new, beginner, intermediate, you should never stop learning. Keep learning. Watch YouTube. There are a lot of good videos. Read books. Okay, there are a lot of good movies about financial markets. Um, Go to seminars, attend webinars, do whatever you can, because continuous learning is really, really crucial. It's very, very important. So keep learning and keep growing, because I'm pretty sure those who are watching this webinar, their end goal is to become a successful trader, right? You want to have this career as a trading. So if you incorporate all of these elements which I taught you today, mark my word that you can become a very successful trader. You will be that 10% out there who makes millions of dollars. All right. But you have to consistently learn and grow as a trader. So with this, I'd like to wrap this webinar. And Really appreciate it, and looking forward in the next webinar. Thank you. If you have any question, you can drop your questions in our inbox below, or you can leave your number. We can reach out to you. If you want to learn about trading, feel free. We will provide you a training as well. So with this, I'd like to end this video. Thank you very much and have a wonderful day ahead.